Hello, investors and traders, and welcome to the Midweek Report. I'm AJ Monty, Chief Technical Analyst with Sticky Trades, and let's get right to work. You may have seen the market rally after the Fed came out and left interest rates unchanged. If you're interested in learning more about how to get that information right as it's being released, I would suggest you go to forexfactory.com, and they have a calendar there that even has a countdown clock. So I was watching this as the seconds were ticking away to the announcement, and as soon, I'm talking a minute after the Fed came out, they rallied the markets. And so that usually happens from institutions. It's not usual that you'll see retail investors doing that. So the institutions pushed it higher, and the Dow closed up over 400 points, and you have to be really careful because here's what the summary of the Fed decision left us with. They're leaving the rates unchanged for the fifth straight meeting. Remember, they originally said 6 cuts in 2024. All right, well, that didn't happen. Now they're talking about expecting 3 interest rate cuts between now and the end of the year, and we'll have to see about that. Core inflation is going up, and the Fed says that inflation has eased, but it remains elevated. I don't know about you, but I don't see it easing, especially at the gas pumps and at the food store. I'm telling you, I'm watching what's happening with tomato plants that my wife and I went out to go buy because we missed the planting season as I was under the weather. And tomato plants, 4 inches high, are $6 a piece. Folks, they don't measure that into the core inflation. They disguise it. But inflation is there. We all know it. And even the Fed is talking about how it remains elevated. Now, here's what's really interesting. The Fed does not expect rate cuts until greater confidence inflation is moving to 2%. Well, that leaves them open for a lot of wiggle room, if you will, because that is something that they're going to talk about with regard to let's pull our decisions from the data that we get. Well, as far as what we're seeing, inflation is still high, and the Fed is trying to cushion the blow there. Remember, they talked about a soft landing. We're not going there, folks. Let me tell you what we're seeing. With higher inflation and a struggling economy, we are headed for Jimmy Carter days of what's known as stagflation. That's when you have a recession combined with inflation. That's the worst kind you can get, and we're headed right down that road, and the Fed's not even addressing it. Now, here's what's, again, interesting is that the Fed only sees 2 rate cuts in 2025 and fewer in 2026. That's too far out for me to have any kind of confidence that the Fed is going to continue. And what happened to the Fed pivot? Well, we didn't see it. Now, if the Fed does decide to lower rates, you have to understand something. That is not good for the economy, because if you go back and look at history, every single time the Fed has pivoted with lower rates, it threw us right into a full-fledged recession. Being that we're so overinflated right now with the general markets, and you can see that from the monthly chart here on the diamonds, we are still moving with these solid green candles. But look down below. Look at the CCI. CCI is headed lower as the prices are going higher. Not only that, but month after month, we are having lower volume months. So the volume is dropping on the way up. That is bearish because that tells us that the buyers are losing momentum. Now let's go back to the daily chart so you can see what I've been talking about here. If you remember, 2 weeks ago, I said we were caught in this range where we're most likely going to oscillate. Well, today could be a breakout of that range. We'll have to see if we get any follow through tomorrow and Friday. We'll have to see. But if we do get a breakout of that range, generally how you measure the move after that is you take the range or the width of the range right here and you attach it to the breakout point. So if we have the width of the range looking like that, and we have a breakout point, we could see the Dow or the diamonds moving closer to 400 from here. That could be closer to another 500-point move higher. Again, I can't draw any trend lines or forecast lines until we see whether or not we get a follow-through on the Dow. Now, going to IWM, we've hit all our upside and downside targets. Remember, I did a two-part forecast on that. Said we would go higher. We did that. We bumped our head against the moving average, came right back down to 245, hit that target, and then we moved right back up because of what we're seeing here with the Fed. Look down below in IWM. We're crossing over the momentum line. That could mean a little bit higher. Again, I could draw a target on IWM because of the momentum cross down there. So I'm going to draw the diagonal line that we call target lines here for you. Remember, I follow the 7-point trading checklist. So cross over that moving average on higher volume with the momentum cross down on the CCI tells us we could go higher. So 208.34, I'll put that out till Friday, and then we'll have to keep an eye on the volume as well. If we get a drift or a drop in volume towards the end of the week, then this whole area up here becomes resistance. I'll leave that line up there until Friday. Looking at the Qs, came very close to hitting the downside target and then bounced. Okay, so this is very similar. Probably going to go a little bit higher towards the end of the week. I'm just going very slightly higher, 445.80, and then we have resistance all the way at the top up here. So that's a short-term forecast for the next couple of days. Keep your eye on the volume. We didn't really get a big boost in volume on the Fed for the Qs. And the tech sector is kind of lackluster there with the volume. We still have an overall drop in volume from last Friday. So we'll have to see how far we go. But again, upside target short term is 445.80. Looking at SPY, you can see the same thing. We got a breakout on slightly higher volume. I'll go a little bit higher, just a tad higher. And the reason I'm only going slightly higher to the end of the week on SPY at 522.17 is because the oscillators are already moving into overbought territory here. So I can't go too high with that one, but I'll put an upside target, 522.17. Now here's another reason why I'm not going too high on SPY. Look at the VIX. The VIX is hitting all of the targets. If you notice, see these pivots? I mentioned that last week. See how the VIX is bouncing? Well, now all the downside gaps have filled, including this gap at 1301. This was very interesting because if you look at the top up here, as I highlight that cursor, look at today's low on the VIX. It's exactly at 1301. So that gap has now filled. Why is that significant? Because if we go just a tad lower and we start testing this support level down here, we're probably going to reverse just like we always do when gaps fill on the VIX, especially gaps to the downside like we see here and even here. It's filling, and whenever we get to that level, you've got these support levels, right, the gap fill points, and that's why we had these pivot points. Now, the VIX is doing a great job with hitting my target line, so I'm keeping that VIX target on the upside into next week at 1588. So for those of you who trade the VIX, I mean, that's a big percentage move. If it's trading around 13, could get closer to 16. You know, you get a $3 move on a $13 price action. That's not a bad percentage move. So those who trade the VXX and some of the other volatility ETFs are going to be loving a rally here at this point. Just remember, you got to manage your risk, just like any other stock that you would trade. Now, we have been trading from the long side this week. A trade publication went out to our equity trades today, and already within hours making money. That trade publication went out before the Fed announcement, and I can't give the ticker away, obviously, because of the paying members pay good money, but we are still looking at short-term buying opportunities until we get a significant breakout below support levels or trend lines. So that is the report. Remember, tonight from 6 to 7 p.m., as I do every Wednesday, we have the rapid fire stock analysis session. I'm looking to do 70 stocks tonight in 60 minutes. We did 70 last week, and almost 35% of the price targets out of those 70 stocks, almost 35% of them have already hit the price targets in just 1 week. Now, over time, our average is that price targets generally hit over a 60-day period. That's something that we have a lot of fun with every Wednesday. So if you're interested in plugging into that, just go to stickytrades.com. You can sign up for a 2-week trial and then plug into the Wednesday session for that action-packed hour called Rapid Fire Stock Analysis. So I'll talk to you on the next one. I'll be putting out the weekly market report on Friday after the close. Until then, you have a good rest of the week. Bye-bye.